All right, let's get into it. Today, we're going to move past all the theory and really get our hands dirty with share capital. This explainer is all about solving the kind of practical, numerical problems you're actually going to face. We're going to learn by doing. So, let's dive right in. We're going to walk through 3 classic accounting challenges, one after the other. First up, we'll tackle what to do when way more people want your shares than you have to sell. Then, we'll look at how to handle the books when a shareholder doesn't pay up. And finally, we'll see what happens when you resell those forfeited shares. So let's kick things off with a scenario that's actually a pretty good problem to have: oversubscription. This is what happens when your company is so popular that you get applications for way more shares than you're even offering. Okay, so here's our first problem. Pant Limited wants to issue 50,000 shares. Simple enough. But boom, they get applications for 60,000. The directors decide to stick to the plan. They'll allot the 50,000 they wanted to and just refund the money for those extra 10,000 applications. The big question is, how do we make this look right in the journal entries? If you break it down, the process is actually super straightforward. There are just 4 logical steps. First, you have to account for every single rupee that came in the door. Then, you officially move the money for the shares you actually issued into the share capital account. Step 3, you've got to give the money back to the people who didn't get shares. And finally, you just carry on with business as usual, calling for the next payment. So what does this look like in the books? Well, that first entry shows all the cash that flooded in for all 60,000 applications. But the second entry, that's the magic. This is where we sort everything out. We move the value of the 50,000 shares we did allot into share capital, and at the exact same time, we show the money going back out of the bank to refund those extra 10,000 applicants. It balances out that initial entry perfectly. Okay, we've handled oversubscription. Let's level up a bit. Now we're looking at what happens after the shares are out there, but someone stops paying. This is called share forfeiture, and it's a really important process. So here's the situation. A shareholder paid the initial application fee, but that's it. They ghosted on the allotment payment and the final call. But here's the twist that makes it interesting. The shares were issued at a premium, and that premium was part of the allotment payment they never made. That little detail changes things. And that brings us to this absolutely crucial rule. When the company first asked for the allotment money, it would have put a credit in the securities premium account, expecting to receive it. But they never got the cash, right? So now we have to reverse that entry. We have to debit the securities premium account to cancel it out. Now, if the shareholder had paid the premium, we wouldn't touch this account at all. And check this out. You can see that rule perfectly in action right here. We debit the equity share capital for the full amount that was called up. And since it was never paid, we also debit the securities premium account. Then on the credit side, you see the amounts that were never collected. The final piece, the forfeited shares account, gets credited with the only cash the company actually got its hands on, that initial 20 rupee application fee. All right, on to our final piece of the puzzle. Just because a company takes back shares doesn't mean they just disappear. Nope, the company can turn around and sell them to someone else. This is the reissue process. Okay, this one has a few moving parts, but it really brings everything together. So 2,000 shares are forfeited. But then the company only reissues a portion of them, just 1,500, and they sell them at a discount. Our job is to account for that reissue and, most importantly, calculate the profit on just the shares that got sold again. Don't worry, the best way to tackle this is, you guessed it, step by step. First, we'll journalize the initial forfeiture of all 2,000 shares. Second, we record the new sale of just the 1,500 shares. Third, and this is the key, we have to calculate the profit, but only on those 1,500 shares. Finally, because this is a capital profit, we transfer it to a special place, the capital reserve. Let's start with the forfeiture. The company had called up 75 rupees per share, so we debit the capital account for 2,000 times 75. The shareholder had paid just the application money of 25 rupees. So the total amount the company gets to keep is 2,000 shares times 25 rupees, which is $50,000. And that amount gets parked in the forfeited shares account. Now for the reissue, and this is where it gets kind of cool. The company gets 65 rupees per share in cash. But wait, these are 75 rupee paid up shares. So where does that 10 rupee difference, that discount, come from? It comes from the money the first shareholder left behind. We cover the discount by debiting the forfeited shares account. It's like using the old shareholder's down payment to give the new one a deal. This brings us to the grand finale, figuring out the actual profit. Remember, the company can use that forfeited money to offer a discount, but whatever is left over after that discount is a pure capital gain. Let's break down the math on a per-share basis. It's way easier that way. The company kept 25 rupees from the first shareholder. It used 10 of those rupees to give the new shareholder a discount. So the net gain, the surplus, is the difference, 15 rupees per share. Now we just take that surplus and multiply it by the 1,500 shares that were actually reissued. And that gives us our magic number, 22,500 rupees. And since this is a capital gain, not an operational profit, the whole amount gets transferred right into the capital reserve. Job done. So let's just do a quick recap of the big rules. With oversubscription, you either adjust the money or refund it. With forfeiture, you only mess with the securities premium if you never got paid. When you reissue, your discount can't be bigger than what the first person paid. And finally, any profit you make from reissuing shares is a capital profit. It goes straight to the capital reserve. We've really nailed the how to do all this, but let's end with a bigger why question. Think about it. How a company handles these situations, how quickly they forfeit shares, or what kind of discount they offer on a reissue, what does that tell investors about their financial strategy and how they view their shareholders? That's something to chew on.